Angola is located on the South Atlantic coast of West Africa between Namibia and the Republic of Congo. It also is bordered by the Democratic Republic of the Congo and Zambia to the east. Despite its oil riches, Angola is a miserable place for many to live. The country churns out 1.2 million barrels of crude oil a day, making it Africa's second biggest producer after Nigeria, yet about half of its 33 million people live on less than $2 a day. Graft is rife and most government services are shoddy or non-existent. That's an ideal environment for the European Union to knock on its door. Angola is an extremely expensive country to live in. From housing, transportation, education, healthcare and other types of services, it is almost unaffordable for many. Companies must pay high salaries to expatriates to compensate for the exorbitant living costs. Long dominated by state-owned companies, a legacy of its socialist past, Angola has embarked on ambitious privatization programs, but progress has been slow. The refining of crude oil and distribution of its derivatives remain well below domestic demand. The Angolan oil and gas upstream market is expected to record a growth of more than 1.5% during the forecast period 2022 to 2027. Angola is heavily dependent on imported refined petroleum. The country spends over $2 billion on petroleum imports annually. To address this imbalance, the government of Angola is prioritizing refinery development, with upgrades to the country's only operating facility in Luanda, as well as 3 new projects in the pipeline. After 5 years of recession, Angola's GDP increased 0.7% in 2021, according to the World Bank, and the Finance Ministry expects growth of 2.7% for this year. Inflation is falling but remains above 20%. The country's debt burden soared to a record high of 131% of gross domestic product, GDP, in 2020, then fell to 75% last year, helped by higher oil prices. Angola's roads, railways and imports are underdeveloped. The transportation of manpower and goods by air, to the enclaved Cabinda province, north of Angola, increases the cost of operations. There is no road linking Angola mainland to Cabinda as they are separated by the Congo River, which at some points is difficult to navigate. 3 refineries with a total capacity of 400,000 barrels per day are being built at the time of making this video, and the installed capacity of an existing refinery is being trebled, so one hopes that Angola will eventually produce more refined oil products than it consumes. Lastly, Angola signed a $5 billion memorandum of understanding with its neighbor to the east, Zambia, to build pipelines between the two countries and transport gasoline, diesel, kerosene, and gas from Angola to Zambia. The project will create between 12,000 and 14,000 jobs in both countries, an important feat by any measure. The envisioned liberalization of the downstream sector is pushing for investments. The recent deal between Puma Energy, Trafigura and Senangol, whereby the latter sold 100% of its shareholding in Puma Energy to Trafigura and bought Puma Energy's Angolan business and assets, was anything but accidental. Angola's oil and gas sector business environment remains one of the most difficult to navigate even after policy changes had been introduced into the sector. Immense industry barriers and macroeconomic threats persist, and hamper even reputable multinationals and the smartest local company willing to enter the sector. Angola and the European Union are set to start talks for a trade deal this year after European Union and African partners approved a request from the oil-producing nation to join a regional trade bloc, according to an European document and an official. The green light to start negotiations came in late July this year. We are now in a position to open formal negotiations, but there is not yet a date agreed with Angola. We expect this to happen in the last quarter of this year, told an European Union spokesperson. The Angolan government had no immediate comment. The possible deal would likely increase the export of Angolan products to the European Union, and possibly reduce the dominance of oil, which currently accounts for nearly all exports by value. Angolan products such as frozen shrimps, ethyl alcohol, wheat bran and bananas are likely to benefit the most thanks to the expected lift of tariffs, according to EU estimates. With the boost in trade expected from the deal and EU's increased need of fuel, amid the energy crisis caused by the war in Ukraine, Angola might also export more oil to the 27-nation bloc.
We're counting on the existing production base and on the development of marginal fields and the exploration of development areas.
Currently, China is by far its largest customer, despite oil now facing no import duty in the European Union. Most Angolan exports to the EU already benefit from preferential treatment because the country had been classed as a least developed nation. But thanks to its recent oil-fueled economic growth, it is set to lose that status in 2027. That means it would face tariffs on several products, unless it joins the regional trade agreement the EU signed with 6 southern African nations in 2016. Under the deal, European Union's products will also access the Angolan market with lower duties, an advantage for local consumers but a risk to domestic industries if they do not invest to remain competitive.
Basically helping the country grow as a whole.
Under the regional trade deal, the EU entirely removed tariffs and quotas on any imports from Botswana, Lesotho, Mozambique, Namibia, and Eswatini, and almost entirely lifted duties on South African exports, which remain however subject to quotas. In exchange, the southern African countries removed duties on up to 86% of European exports. Additionally, Angola has recently executed bilateral investment treaties with Portugal, the UAE and Spain, in the hope that this will promote further investments. With these reforms under its belt and thanks to the ongoing vaccination campaigns, Angola is certainly one of the economies in Africa better positioned to embrace the future with confidence, knowing that it is just a matter of time until investors start looking at the country as the place to be again.
We now have a leading position in Angola. We represent 45% of the country's production.
Opportunities are clearly there, and investors from Europe, notably France, Germany, Italy and Spain, UAE, and Japan, are being quick off the mark in seizing opportunities in Angola, knowing that those who stay together through thick and thin will be rewarded in the time of plenty to come. For the European Union, reducing reliance on Russian gas is not going to be an easy task. However, if the capital necessary to build Angola's gas infrastructure is accrued and the security of energy supplies from the continent is ensured, Angola has the potential to reduce Europe's energy dependence on Russia.